Hello guys, glad to have you on board again today for our first experience level podcast. So just like I've just did it for the French guys, I think that's a pretty good improvement anyway. I mean, the first feedbacks I've got from this brand new ID are pretty positive so far, so we're gonna stick to this. Like I said, we're gonna make somehow of an overview of the results probably 1 month from now, because it's still a little bit too early to get to positive conclusions. We need to make this, we need to see how it evolves through times, but anyway, just doing this for the French guys feels much better to me, because I'm focused again, and I think that's for the best. My previous concerns was like, sometimes, like I said, I have to talk to a so wide audience that it is sometimes complex, because I'd like to express some feelings and some stuffs, but I know that these stuffs will definitely mislead most of the beginners. Reason why I generally tend to say it anyway, because it matters for more experienced traders, but I have to go into endless explanations and warnings just to try making sure the beginners won't be falling into traps. So now I don't nearly give a shit about that anymore. It's your own problem. So if you're a beginner and if you're having a look at those shows, then you better have to put your own warnings, because now it's no longer my problem. I'm going to be focusing those shows for the experienced traders. So tough stuff down the corner. I'm not going to go easy, and I'm not going to go into the easy warnings. Normally those guys who are listening right now are freakingly aware of what risk management is, so you know how to deal with what I'm going to be saying in here. Alright, there's not going to be warnings in here. Alright, that's much better for me. I'm stop wasting time into endless blah blah, and I get straight to the point. But really important that you put your own safety net in here. If you listen to that shit and if you're not ready for it, you will suffer the consequences, and they will probably catch up rather sooner than later. Alright, so if you're not ready to pick up on experienced level stuff, please stop that fucking video right now. Alright, you're not going to be missing anything important for you. You're going to miss some things, but things that doesn't nearly matter for you right now. Focus on the essential. You're a beginner, try to learn that fucking strategy more than anything else. What we're going to deal with in here is way more complex and subjective than what you have to learn first. Anyway, let's go down the rabbit hole with the experienced guys. So, today I think we're going to talk about how to efficiently use the volatility stuff that we introduced on Wednesday, how you can really profit from that, into what kind of market this can be really useful, what kind of patterns you need to trigger and stuff like that. Also go down another rabbit hole, so we're going to talk about what happened with the with the repo market. So you know, this is the overnight lending system, mostly handled by the Fed. So Fed is lacking of liquidity, or at least there's some problem with, like, call that the oil that is just making sure this very fully run engine is not going to burst. So huge problem regarding this sector. Remember that, to those who are following for a long time, I've been talking to you about the repo market for quite a long time, telling you that you have to watch that, to overwatch the thing. Out of a few other sectors, really important still, the junk bonds, so the high risk junk yields. We also need to have a look at how bonds are pricing according to VIX, to those junks, the reverse yield curve, though, all those stuff. We needed to have a look at the VIX pricing structure, and on the underlying structure, keep an eye on the gold. So now let's sum up those information. Gold is now bullish, and they try to force it down, but they just can't for now. VIX is still making new highs and new lows, so and higher lows. So still a big problem coming along the way with the VIX. The junk bonds, no matter how hard they try, can't make a resistance breakout. They broke one tiny resistance, but certainly not the major one. So we're still in that ugly triangle. The yield curves since then have been ugly reversing into every aspect. So first of all, the short-term maturities, the 3 months, then the 2 years. So now the entire yield curve is reversed. Not a good sign, definitely not. Does that mean it's an immediate risk? No, we know it's not. So we know anyway the dominoes are starting to fall, but they need to create a systematic risk increasing to get to the recession trade. We're not yet there, as anytime we see a problem, the Fed is here to save. So reverse yield curve, what did we have? Support, yielding's putting down, so the Fed is rate cutting. All right, so that's exactly what's been causing the reverse yield curve, by the way. But that's it, all right? Reverse yield curve, so what do? We promise there will be no rate cut, but the reality, there are. So the market doesn't believe the central bank anymore, otherwise they wouldn't keep the reverse yield curve. The junk bonds not rising resistance, so the market doesn't believe the oversold market. Like, we've sold too much, we've priced in too much bearishness, so only bullishness is to come. They're definitely not buying that right now. So we're waiting for the moment that the bearish market will take it over. For now, it's very dangerous as we're still back into historical highs in Wall Street. But still, you need to have a look at who's participating. Huge divergences right now. So let's have a look at the sectors. All right, so as you can see, who is getting to make Wall Street strong? What the hell? XLP. Where the hell don't I have my label? Where have you gone? So XLP. Sorry, I just rather like to verify rather than say consumer staples. So, God damn it! Where are my fucking labels? Oh shit. It's just a trick. I'm sorry about that. So, staples. Damn it. All right. Say consumer staples. Though consumer staples, all right, so this is what drives the price action recently. We already have new highs on those sectors, all right, but now have a look at the rest of the market pricings. All right, materials still heading to the downside. The technology sector trying to make new highs, but not really great. And just have a look who's really leading the market right now. Who's the one rising at the fastest possible pace? Utilities, and I told you that's a huge concern. When utility leads the market, means we're generally rotating the market towards safer areas. And when we tend to do this, generally not a good sign. XLV is healthcare, all right? So, I don't know why the hell those labels somehow disappeared. Oh, yeah, I know. All right, these are not these ones. These are anchor text. Come on, baby. All right, here it is. So this was health care. All right, so you know I'm selling healthcare anyway. We'll see if the market was about to surge. Who do you think is going to be one of the leaders? Industrials, probably healthcare to make new historical highs. So anyhow and anyway, do you really think technology is going to be a leader? They're not going to be, all right? So if the market wants to rise higher, it's probably going to be profit taking in utilities and buying entries on healthcare and industrials to make new historical highs. But if we have a problem, all right, which means if we build a new resistance, then let's just figure it out, all right? Sorry, I need to push this one out. Trend line. Oh, beauty, right? We would be creating another trend line in here. In here, obviously, crashes down the corner regarding the crazy high valuation. This would just have been the volatility return that just creates a divergence. And obviously in here, just the profit taking will cause this market to crash. This one is a bubble. So this one is not going to just consolidate. It's going to break this low, all right? This one would be like somehow we try, but we fail, which means financials will not necessarily crash. Just like I said, I think two sets of waves to consolidate, in which the first one's been done. The second one could lead us there, right? So pull back into the previous 2014 tops. That would be absolutely normal for financials, and that would be an actual not that bad entry point for them if we get there. But I don't see any more bullishness to be expected in this market. They try as well. They just don't want to surrender. But when the market switches bearish, we'll see bearish targets instead of bullish ones. So instead of your eyes focusing on these areas where the market could go, you would fear, oh man, no, the market's going there, so as we go there, where are the supports? In here, then in here, will totally change the vision. When the market long-term reverses to bearish, you'll see that the psychological behaviors in the market get significantly different, right? So in here, same thing. If we go bearish, where are we going? All right, in consumer discretionary, it's hard to say. We've got those support area, which were previous resistance, or this ones, and this is where we're going. In here, it's not necessarily bullish. So the thing is that we generally, I think, in those kind of markets get to retrace in two waves. Right? First wave generally probably will stand to the 23%. I don't think this one will be one of the sectors that will break the lows. I think consumer discretionary will somehow sustain some of its gains. All right, but I think the second set of wave will probably be the shorter, the fastest one. Getting probably, I think, to this area. Eventually, if things really get worse, this one. But I don't think this will be one of the sectors that will be mostly impacted. Obviously, minus 40% drops in here along the way. If they go down, no surprises. But where the big problems are is in here, where the minus 50% is just a strict minimum. Technological sector will probably retrace 80% of the valuations, getting from 80 on this index to 30, right? Like, if we go there, like I said, it's not going to be straight line. It's going to be a long, pain-fucking trade, because technological sector will probably not be the leader on the next economic cycle. So many people tend to believe they will. I can tell you that they won't, simply because that's how it works. When people think something is obvious and necessarily going to happen, we just fuck them up. Healthcare, I think we're going to pull back to those areas, and they're going to be a buy entry anyway. Industrial is pretty much the same. People think the industrial sector is dead, whatever. Let me tell you, I think that's going to be interesting for the next economic cycle. But I'm buying on support area as well in here, so probably same area. Like we get a 30% drop. Consumer staples is one of the sectors that is probably going to be fucked up instantly. We can see the same old problem with the divergent wedge structure, all right, in which I think the next stop in here is going from 64 to 44. So everyone pulls back to the context, to the support context, I think is the most reliable thing to do. All right, utilities generally tend to reverse, which means they break their trend channel. All right, they're not bullish. All right, they're just evolving in a trend channel. All right, so we're on the top of the trend channel, we go to the bottom, and we're probably going to break it this time. So it's breakout, pull back, bearish breakdown, and then that's it. I think for a recession, that's all we can hope for in the utility sector. Look, remember that we're having a look at monthly charts. So anyway, it's somehow a breathe out for a few years, no more than just 1 year or 1.5 years of consolidations in the U.S. equities to May, if it happens, and that's it. All right, and either we do it in a sharp, brutal reversal, like a fast market crashing, especially into technological and consumer staples, like we fuck up 50% valuations in there, and if we do it fast and the central banks can still support the economy, I think that we can buy the dips. Otherwise, just wait for 1 year from now to buy the dips. Just go short, wait for a year, pick up the money, and use that money to buy again. At least that's my plan for long-term forecasts. Anyway, let's get to volatility trades right now. So how do we profit from volatility? Out of what we said yesterday, we're going to go a little bit further in here, how to get practical examples for you experienced traders. So we generally start the process by highlighting something that doesn't go according to the plan, something that just basically fucks up technicals. When a market goes straight line from point A to point B, generally means something goes wrong. The market shouldn't be acting like that. The market is all about uncertainty and risk management. That's what I teach you. That's how the market works most of the time. Still, there are some areas of uncertainty and stupid pricings and whatever. I tend to call them distortions or manipulations, call them however you fucking want. That's not really the point. The point is, when they happen, how do you react? And there are multiple options, and what I'm going to teach you today is something I just learned over the latest couple of years. This is things I'm going to add to my personal strategies. Like I told you, I wasn't nearly using Bollinger Bands. I will use them in some specific context because I think they're going to be more profitable than just sticking to trend channels every time. So I told you that. I put them in the strategy, so I'm going to be using them. So I'm going to teach you the patterns I've been highlighting out of this, and that is the stuff I'll keep aside for the beginners, or I'll explain them differently. So I'll go straight to the point in here, all right? You know about risk management, so I'm not going to make it easy for you. So the thing is, when things go wrong with an asset, let's pick one. Like WTI has been recently, but let's pick up the gold. Those who are there for long enough, remember this area. It's been really tough to trade. I remember I took some bullish trades in there to try supporting 76% fib on this ranging movement. So let me just pick up the ranges. So, all right, remember we took a trade, speculative trade on this 76% fib area. All right, so it was in here. All right, try to be bullish in this area. Didn't work out, and the market didn't give me any risk management in there. They just kept on pushing straight line. All right, so that's not normal. That's not how it goes. Normally in here we should have had a pullback to risk manage and then broke down this area. Instead we go in straight line without reasons to do so. All right, and we just fucked up the market instantly. All right, sorry, I need to switch to pro channels. All right, so all right, trend channel, support context, everything we needed. We were trading at a target. Remember that those targets, even if they mean we're going to go lower, they generally block the prices anyway. All right, so we were supposed to be blocked in here, and instead of blocking, we've gone straight line without breathing, without anything. We just gone straight for stop losses. So when these things happen, this is exactly where you can start using the Bollinger Bands. When the market behaves abnormally, without reasons to do so, without clear explanation of what the fuck happens, and instead of bursting volatility like it should be, high level of indecision generally comes up with volatility. So in here, instead of having volatility, we see low volatility, and we create what I generally tend to teach you guys as being the washing machine. We create tiny trend channels in which the market evolves stupidly, stubbornly, like we don't think, we just keep on going, not even figuring out why the hell we do this. All right, and when this happens, now I know why the market gets irrational and just seek for volatility. So when it happens, you instantly have a look. I'm not saying you obviously trade with Bollinger Bands, but you have a look at Bollinger Bands, and they generally give you that answer. It's not a certainty, it never is, but when you see this, you would have figured out, and what you're going to be looking forward for when the market gets irrational like that, look for the highest time frame, or you go from short time frame to the highest time frame, and look for one that will show you contractive Bollinger Band, so narrowing volatility amplitude. All right. In here, we were out of the daily charts, and we're having irrational pricing regarding usual trend analysis and stuff like that, all right? It doesn't look like a range, it doesn't look like a trend, and it doesn't look like an excessive market. So what the hell does that look like? It looks like nothing that we know about. Then when that happens, just switch to Bollinger Bands, and if the current time frame doesn't show you narrowing Bollinger Bands, go to the higher. And normally the higher time frame will give you shrinking volatility, and you'll wait, simply wait, all right? The rule in this context is stop acting stubbornly in here. If you've been stopped, and if the market is creating those ugly trend channels, ugly washing machine system, you know the market will keep on fucking you, or at least odds for the market to keep on fucking you are significantly increasing. So stop fighting. I should have stopped fighting at that stage. I remember I shouldn't have tried again in here and tried again in here. I should just have said, all right, you know what? I do nothing. I wait. I don't sell the market. I just wait, and I'll wait for the standard deviations to be reached out to. And when the standard deviation get reached out to, this is where you speculate aggressively. But being aggressive in here and in here, it was just a waste of time. and energy. I was focusing on this fucking goal, trying to figure the fuck out why the hell we were doing this. Remember those shows in which almost 2 times a week I was saying, what, gold again? God damn it, what the hell is going to happen? The market is acting irrational. We have distortion pricing. So I told you, all right, I'm going to search for the market reversal, and when I'll get it, I'll trade the same thing. And that's exactly what happened. Remember, I've been fucked a few times in here. I was stubbornly buying in there, and then obviously I took the nice gain afterwards. So anyhow, I ended up winning the game, but I should have been more profitable with a bearish movement, more patient, still as resilient as I am. You know me, I'm not changing my fucking plan unless I get truly proven wrong. Right? But generally when I get proven wrong, it simply means I'm wrong in timing, but I'll be right later on. And the problem is, that's how you need to deal with. And if I end up being wrong, meaning wrong, that I cannot find any more timings to prove me right, and I just surrender. That's exactly what happens in Wall Street right now. I exploited 3 bearish timings so far. That's significant in terms of number. I eventually will try a 4th one because of the stupidity of the current context, but there's not going to be a 5th one and a 6th one. At some point, I'm going to stop selling Wall Street because there was a timing, and that timing is reaching its end. At least we're getting closer to the end more than anything else. So let's take another example in here. Which asset has been acting pretty irrationally over the latest couple of years? Obviously Wall Street, but we've already dealt with this one. Oh, the BUNDs. These ones have been crazy hell. Yeah, crazy hell. Alright, so here's the BUND. Alright, so remember, that was so freakingly irrational in all those areas. Same thing, low volatile, as in here we should have gone down. And then look at what the market is doing. The market is reaching for Bollinger Bands. In here, the volatility was shrinking. Alright? Okay, even if you have a higher Bollinger Band in here, the volatility is still shrinking, which means this box still rising, but rising with a slower pace than this one is rising. All right, so the volatility is reducing. So we're losing volatility in the BUNDs, though the market gets more volatile, more stupid, more excessive. What the hell do you think that means? That means this thing will crash. That's exactly it. We're going to go straight to the opposite Bollinger Bands, and pretty much I'm certain about it. It's just a matter of time, and it's just that back in those days, I traded those areas, you remember. So I have no problem with the BUNDs. I think I've done my job. It's just that we've gone a little bit further just to trigger that stop pattern, but that's it. We're done with the BUNDs. It's over. I told you we're not going to go higher. People tend to believe we will. I don't think we can. I think it's over. That's the reason why I told you credit has been reaching out to a very dangerous corner in the euro area. Even if QE, whatever, it's terminated. All right? But the problem is I'm done with the fucking BUNDs simply because they're nailing me each and every time by those rollovers. So it's really pissing me off. Remember the natural gas when we were trading it a couple years ago? That was exactly the same shit. Everything I traded was fucked by the rollovers. So I like to take risks, but I want the reward. So when the market pricing the risks and fucks the reward over the rollovers, which means money I can't take, then, I mean, to me, it's not a fair game. So I'm not playing if the game is rigged. It's simple as that. So all those shitty expiration trades, I don't want to trade those assets, all right? Like, there are expiration into many things, like there are expiration in the futures contracts and whatever, but you never see a 2% rollover into Wall Street's contracts. I mean, that happens every fucking time we've got a rollover with the BUNDs. So something definitely goes wrong. And all my gains are especially fucking dropping into those rollovers. So I get to take the risk, I get to pay for the risk, and I don't get rewarded. So yes, it pisses me off. Like I said, I feel like I'm playing a rigged game, so I'm not simply playing that game anymore. As simple as that. I'd like to, all right, but I think like it doesn't worth the risk taking. Maybe I'm gonna let it go. I sincerely think that all that shit is gonna end up with a pretty ugly trade. I'll probably have to miss that trade. But if I was going to sell right now, what prevents me from being fucked once again? So no risk management, I can't. Selling on top of these areas, definitely yes, that's what I did. But the problem is I got pushed out right at the rollover, and the market fucked the prices on the rollover. All right, so if I could have taken those prices, I would definitely be in selling right now, but I just can't. Right? Anyway, other things you need to have a look is always the same thing. Have a look at the yen, have a look at the dollar, have a look at this, have a look at junk bonds, and have a look at the yield curve. And you'll figure out what the hell happens with Wall Street in the next following weeks. You'll have the swing trades showing up. If you see Wall Street going down, if you see this crossing over zero, if you see the junk bonds heading back to support area and starts to break the trend lines, you know the game is over, all right? If you see the VIX breaking and maintaining these lows, and that's the structure you need to figure out. Sorry. All right, so the VIX, this is how they're pricing in. Remember, the VIX is generally, we go bullish, and in here, that's where the market is saved. All right, the market is saved, so we dip, we make new historical highs, whatever, all right, and then we pay the shit we've done. That's exactly what we do, and anytime we make higher highs. So the thing is that, what's coming next? All right, do we still have this part to take care of? Because if we are just there, then this is what should come. What should happen next? This is the next volatility expiration. So if everything goes fine, Wall Street will probably try to break new highs. Volatility will make new lows. We'll try to break the short-term resistance in the junk bonds. Probably the dollar will stay where it currently is. The yen will try to break a support. And you understand, that's a mechanic. That's what's happened every fucking time in the past. Everyone still tend to believe it's going to work just fine this time. One time, there's one day it will not work. People will get wrong-footed, and as they'll figure out they will be wrong-footed even more, they'll start switching, looking at support area instead of looking at breaking resistances. And when the day comes, you'll see the VIX will behave pretty significantly different. All right? I told you I was expecting those two waves to be enough. They managed to save the fucking dip in here. I don't know how they've been doing this, but they managed to. But here we are. All right? We're making we're getting in here. We're trying to make higher highs, but the volatility is still making new lows. So in here, if we stop, right, that would just have been a more complex pricing structure in which two sets of waves, one up, and two sets of wave bearish. But that's not bullish, that's not bearish either, right? It's no bearish trend on volatility. If we just fail in here, hold the support, and starts to break the resistance instantly afterwards, and don't do this, all right? If we pile up this, then yes, obviously Wall Street new historical highs, yen breaking supports, you know the drill. The risk on mode, risk taking. You know what the hell they're going to be buying, all right? They're going to be buying the healthcare system, buy everything that's been lagging and that can be pushed to new historical highs. But certainly not going to buy technological sector. All those guys who are already at market tops, they're probably not going to be the ones to be bought. All right, so if we do this, if that's what the plan, then they'll push us probably up to the next expiration to try closing volatility at the lows. All right, though I'm not going to buy volatility this month, but I'll try buy it next month. If anything goes wrong in here, and as you can see, we already have profit taking structure in here, the same we've had previously. Instead of just after profit taking, they've been somehow saving the market once again. I don't think that happens. The market don't feel like it's going to be saved this time. They're hesitating. So we'll see. If the market feels relieved, then like I said, we're going to crash down volatility for the expiration. If the market tries a relieve, like what we've done in here, tries a relieve and fails to break, which means in here we restore and we break that area, then this is where the shit start to hit the fan. And if that happens, like I tell, straight line to 30, I think there's no other option. Think of it like this is a first wave, this was a first wave, right? Two first waves, significantly same amplitude, consolidative waves, high lows. All right, so what does that look like? It looks like a fifth extended wave. So minimum will be 30, and that would just be a risk management to me. All right, if I get to buy volatility in the next following days, it's 30 risk management, 25, 30, 25 to 50% profit taking, and I'm going to target 50 or 80. I'm going to target just a flush, like the market panicking, and probably if I can see some jitters with the repo markets and stuff like that, again, like if those things ever repeat, Wall Street will get really, really concerned. Like the first time is a flashing red signal. Still, some people will try to say, all right, it wasn't nothing. Let's forget about it. Let's just focus on what's positive. Some other people will say, oh man, that should nearly happen in a normal bullish market. So that's dangerous. And that's what normal risk managers should think. They should say, all right, too many red flags have been, too many red flags over the latest couple years. So too many red flags to go bullish, to buy resistance. That's the reason why I think they're not buying the resistance. They're probably not selling that much, but selling anyway. Like they're selling what they can sell and waiting to see. But I think that every rational risk manager right now knows that we've been piling up quite some risks, that we've been pricing in most of the gains already, that we're very likely eating the profitability top on corporate profitability. So if we cannot price in more profits, if the risks are rising, what the hell are we pricing? Do you want to price inflation if you're expecting the market to crash? No. Inflation is what we price in when we've got growth. When growth is at the level of inflation or even dips below, that's simply a recession. It's simple as that. I mean, inflation is not the only thing that can push prices higher. It can do it, and it can increase pricing higher when there's growth and expectation for growth to sustain. Now we're just slashing growth each and every time. Each and every growth forecast is shorter than the previous one. So even if you think things are improving, people don't think they will keep on improving. They'll think it's just probably the dead cat bounce, like the short-term bullish sentiment reactivating before actually switching to the most bearish one. Like after hope gets the delusion, and when the delusion shows up, definitely comes up with panic sellings and stuff like that. So I still tend to believe panic sellings are down the corner. I just need to risk manage. So that's what I do with Wall Street. I'm still bearish on Apple. I'm still bearish on those stuff. You know the drill. All right. So those assets, I'm waiting for them to answer the question. Do we go rational or do we go irrational? So let's have a look at Apple, for example. All right. This is what we do. This is what we have a look with our usual trend channel analysis. All right, daily resistances, range signals. All right, this is what the strategy tells us to do. If we go bullish in here, then Bollinger Bands. But like you've seen, all right, if we switch to Bollinger Bands, all right, this is where we go. We can go a little bit higher and we'll see how the market reacts. If they go historical highs, I'm going to closely monitor any breakout we could have out of volatility limitations. Because if we just go there and fail on the 2 standard deviation limitation or something like that, you see it's going to move like that, all right, incrementally. So if we just test and fail on the 2 standard deviation, I'm going to sell again. The best case scenario would be just, all right, we're done. We sell it just right now and the game over, all right? Like we just fucking go bearish and that's it. And like I told you, Apple falling is just like junk bonds falling and everything like that, right? Anytime we cross a support, everyone will see that the previous support was there. That support will probably not act again, which means in here we just stopped because we were too much bearish for the whole global market sentiment. But if the market sentiment returns to bearishness, then the last time will probably be, all right, we go there first, and then where do we go, all right? Like it's regarding what we've done in the meantime, how far will we go this time? And like I told you, I think we're going to go there. Like the breakout area will be there, reporting this, all right? Like remember how breakout works, all right? You take that box and you port it to the downside, which brings us to the maximum target, right? As simple as that. Like I told you, many ways to go there. I never thought we would be doing that much shit. But I'm learning how to reverse long-term markets. First time ever I'm dealing with this. I've never seen such incredible level of stupidity. But still, as long as I haven't been proven wrong, I'm just following the plan. Simple as that. So what else could I be talking to you guys about? I think that's pretty much it. Yeah, euro dollar. I think there's going to be something to deal with in the forthcoming days. So let's go 4 hour. All right. So that's what we have. No Bollinger Bands, not necessary in here. We could clearly trading trend channels in here. The market lacks of volatility in here. As you can see, we try to make stupid pricing on the euro dollar, but we fail. We can't do it. The euro dollar is just not moving. All right, it doesn't mean it's stupidly pricing in. All right, it's just not moving. Really, really not moving. All right, here we are. So we're blocked by those targets, and they've been working once again. So at some point, like I told you, I wait and I hope that in this time the trend channel won't act as a resistance, that will go straight to the resistant context. When we'll get to the resistant context, I'll risk manage, but probably no more than 25% because I expect we're going to set the trend in motion and pull back on those trend channels afterwards. All right? So that's what I expect. Don't take the shape, right? Like we can do this instead. It's just a matter of dynamic timings. I think what's important is for us to fuck both the resistant context and this trend channel in the same time, all right? Then we pull back on them to build a higher low. Remember that we can we can rarely break up, meaning triggering bullish trends if we don't build, all right? Like I think we can do something like that. That would be the most rational stuff for the euro dollar. Like a somehow ugly head and shoulder, or at least 2 pullbacks on this trend channel before trending, right? Obviously, that is if nothing systemic gets to fuck up the system, all right? Systematic risk increasing will mean price movement will go faster, which means instead of doing it slow and steady, we do it like bang, two really fast pullbacks and this, all right? Time is unpredictable, and obviously as we'll head to more bearishness, we can have the 2 pullbacks in a very short time and then get crazy bearish afterwards. All right, if the market gets under tension, things tend to accelerate. They'll play according to my plans, like the numbers of pullbacks expected and stuff like that, but they'll just do it way faster. What else? Eventually cryptocurrencies. Yeah, we could have a look at that. So cryptocurrencies, ugly lower shadow candle yesterday. Still tend to believe what I think is going to happen. If you'll have a look at the daily chart, I can clearly see the 2 sets of waves to the downside. I'm still expecting the second one to break that resistance and terminate the triangle, right? Like giving us the final trading, the final triangle boundary. That's the best option. But if we get there and make a candle close below yesterday's lower shadow candle, I think that's a different scenario, and pretty significantly different scenario, in which I think probably 6K or 5K, which means I don't think the 7K area will bullishly react. The target we had in here is over mature right now. It's not limiting prices, which means if we go there, I think we're going to dip below the support context. So I think 6.5K to the 5K area. Like, we'll have a look at this area anyway, because there is a Fibonacci cluster. So we'll eventually look forward for 4-hour signals in this area, just in case. But if this happens, I think we're going to have to suffer quite some bearishness. And I think in that perspective, 5K is down the corner. Right? This is the reason why I've been risk managing on the altcoins as well, because they've been performing, yes. But don't forget that if Bitcoin goes down, they'll go down as well. They might just consolidate, all right? All I care is that the BTC dominance will probably keep on falling. But in here, we might just going sideways. Remember what I said. The BTC dominance final stop to me is in here. It's going there. I'm going to the 38% fib area and the support context support. But going in there doesn't simply mean that everyone goes up and Bitcoin stays there. That's one of many ways we can reverse the dominance. The dominance can also reverse with the Bitcoin getting 5K, where, for example, Ethereum just retraces to 140 and stuff like that. All right, that's another way to bring the BTC dominance down. So, just figuring this one out. 10K to 10K to 5.6K is a 40% drop. All right. Ethereum's instead, if they just retrace the previous support, can make what, 20-25% drops, right? And that would nearly surprise me if they do it. Ripples, They've already pulled backing, but they can pull back to 17 to 20%, or eventually even make new lows on Ripples. I wouldn't be surprised. Right, Ripples have already been making new lows, so they can try to dip a toe lower without problems. So let's say the Ripples can go between 25 to 40 to 30-40% profits losses. I think IOTAs are pretty significantly interesting. They've been breaking support, but they're still holding on some grounds to low valuations. The surge was significant. I was really happy with these ones. If they consolidate, I think they will hardly make new lows, but they can consolidate to this area, which gives us a 20-25% drop. So understand me well. Bitcoin 40% drop, other altcoins 20% drop. What do you think that does to BTC dominance? It brings the BTC dominance significantly downward. So that's one of the many ways we can do this. All right. I think that anyway, trying the altcoin season was the low risk scenario. That's why I bought them speculatively. I never made buy and holds, all right? I don't think the buy and hold timing is about time to come. I think what's about time to come is just volatility. That's the most reliable answer at the moment. Either we get volatility, but I'd rather like to play that volatility with buying speculatively the altcoins rather than selling the Bitcoin, because the Bitcoin could just as well die in here in that fucking triangle, and Bitcoin going nowhere means significant pullback in the dominance. Means this is where you want to speculate. You can put it however you want, it all ends up the same way. I don't think an alt season is down the corner, not yet actually. I think bearishness could be coming, and especially out of Bitcoin. So I'm waiting for interesting prices to load up on some Bitcoins, all right, like long-term Bitcoins investments and stuff like that. And I'm waiting for pullbacks in Ethereum's, Ripple, and IOTAs to load up again on some reinforcements for their speculative trades. I wait for 20% pullbacks on those assets, and when they do, I look for pullback signals, right? Like typically range 3, third range boundaries, all right? So that's the context I'll try to exploit. Let's put that in motion to be precise. I think 4 hour is going to be the topic. Damn it. Sorry about that. All right. So I think, yeah, somehow pullbacks, whatever. All right. So the thing is, no, not 4 hours, not going to make it. So 1 hour. Yeah, 1 hour is going to make it. So, all right. I want a range to build itself. So I want us to go context to context. All right. Then in here, all right, context to context, third range boundary to the downside in here for those who want to. All right, you understand that? And then 4 hour, the opposite way. In here, I would like the market to go there. Oh, damn it, the context remains bearish in here. So, yeah, Ethereum's could have to go a little bit higher in here first. And yeah, we get the target. It's about time to stop. Yeah, no, I think we're done with Ethereum. You can see that a cluster is building in here. We've got the moving average. We're locked with the target. We've got the Fibonacci. So huge resistance out of the 240 area. And we're not getting there the best possible way. I think, yes, Ethereum, probably bearishness to come. So we'll wait for 2 sets of waves. I think a mature 1 hour range will be what we're looking forward for. So I think what we do is wait for retracement. We'll try to catch up prices out of 61%. Hopefully we'll get down to the 76% fib. That gives us a 180 area for a strong support to test. Speculatively, obviously, which means we buy in here, we put a stop loss in there. And if the market reacts, then there we get to the breakout trades, all right? And we get to target the 300 area, all right? So we'll see about these ones. But these are the next area of interest for me into Ethereum's. As you can see, ranging signals showing over. I don't think there's more upside. I think there's limited upside right now. Probably pullbacks, not end of the world kind of pullbacks, as I think we're going to hold to the previous grounds. So just partial profit takes on Ethereum. I've been doing 20%. I think I'm just probably going to take an additional 10% today, which makes 1/3 of the global positions taken profits. So I'll reinvest those 1/3 plus a little bonus, of course, out of the areas I've highlighted. All right. Anyway, that's going to be it for today. So I'm going to leave you guys. Hope you're going to have a great weekend. We'll meet again on Monday for a global portfolio analysis. And then next Wednesday for another experience podcast. I hope you will like this. I will listen to your feedback, not in here, so please don't post into YouTube. You can give us feedback into the Discord, so you can either talk to the moderators or the generals or whatever. But you guys tell me what you think. You can use the specific channels we've got to talk between generals and stuff like that. I'm interested to see what you thought about this. Do you think the difficulty level was a little bit too high? Do you think it was a little bit too low, that I'm getting into too much detail, unnecessary details and stuff like that? So we just adjust the level of difficulty, all right? And we'll adjust as we go. So that's the first one. Don't mind me if I've been talking too much or being into too much difficulty. I'll have to adjust regarding to your feedback. All right? So waiting for it, and happy if you just like that show. See you guys later. Have a good weekend.